Hello, this is Sunko, the Korean bro. Today is 2023, October 25th. Let's see what we have, okay? Hmm. Last but not least, at Amazon to the leisure stocks where smartest investors seem to quietly be scooping up in droves while it's down. If you know the company at all, you likely know why the stocks peeled back from its pandemic prompted peak in late 2021. That is, the inflation bug has eaten away at its usually thin profit margins. Its e-commerce operation actually lost money last year. In fact, both here and abroad, its cloud computing arm Amazon Web Services was the only profitable venture thanks to sky-high logistics and labor costs. Even AWS's net profit margin rates contracted a bit. Its operating costs were up as well. But things are taking a turn for better. E-commerce is profitable gain. For instance, with overall operating income nearly doubling through the first half of 2023. Not only is the company getting a handle on freight and warehouse costs, its nascent advertising business as Amazon sellers pay to feature their products on Amazon.com is expanding by leaps and bounds. Last quarter's advertising services revenue of $10.7 billion was up 22% year over year, extending a growth pace that's been underway for some time now. This is high margin revenue too. Very little of this brewing turnaround is being reflected in the stock's price. Indeed, not only are Amazon shares well below analyst consensus price target of $173.48, they're currently priced below the lowest analyst target of $138. Goldman Sachs analyst Eric Schroden chalks most of his weakness up to worries about its cloud computing business's foreseeable future, explaining investor expectations for near-term AWS revenue growth have come down in the last month. Sheridan goes on to say, however, we would encourage investors to instead focus on the broader margin recapture story in Amazon's North America segment, as we expect margins to continue benefiting from operating leverage against a more streamlined fulfillment shipping infrastructure over the next several quarters. Okay, let's look at Alphabet first, Nvidia next. Mm. Alphabet and Nvidia are ozone favorites to profit from this paradigm shift in technology. There's an age-old debate on Wall Street regarding the value of stock splits. In one camp are those who believe this process is unnecessary as it doesn't change the underlying value of the company. The other camp believes keeping shares within reach of everyday investors plays an important role in investor psychology. More important, however, is the fact that the most stock splits are typically preceded by a period of robust business performance that sends the stock price soaring. Let's look at two companies with a history of stock splits, fueled by strong financial results that could be poised for even greater gains due to recent advances in artificial intelligence. Since its IPO as Google in 1998, Alphabet stock has had a long and distinguished run. The company's revenue has increased by more than 11,000%, while its earnings per share have soared 31,000%, resulting in 5,360% stock price gains. To keep its stock price reasonable for retail investors, the company has split its shares twice. Hmm. The most recent being a 20-for-1 stock split in mid 2022, while Alphabet stock likely won't match the scorching gains of the past 25 years. The company's AI expertise could provide a strong catalyst in years to come. While the storm in online advertising last year posed challenges, Alphabet hasn't wasted any time diving into the AI revolution. Earlier this year, Alphabet debuted its next generation chatbot, Bard, a direct rival to ChatGPT. The company continues to forge ahead, integrating AI across a broad cross section of its product and services, which will fuel its next phase of growth. Much of Alphabet's main focus has been on enhancing its existing Google products, uh, which boasts billions of users, and supercharging its cloud infrastructure service with AI functionality. Google Cloud is the fastest growing of the big three, up 31% year over year in the second quarter, outpacing uh, Amazon and Microsoft, which delivered 12% and 26% respectively. This gives the company a large and growing target market for its AI services. Google is also infusing AI into its namesake search with plans to debut new AI powered features in these coming weeks and months. This infusion of AI functionality should help Google maintain search dominance and will also be an easy sell to many of the company's cloud computing customers, helping it continue to still share from its cloud rivals. Alphabet's digital advertising is still recovering from last year's downturn, and it hasn't made much of an impact on its cloud results thus far. In second quarter, cloud revenue rose just 28% year over year to $8 billion. But as demand for AI continues to accelerate, Google Cloud should reap the rewards of Alphabet's continuing AI investments. NVIDIA has a long history of performance in stock splits, with the most recent a 4-for-1 stock split coming in late 2020, resulting in revenue that increased by nearly 19,000% and EPS that grew 66,000%, driving its stock price up 56,000% since its 1999 IPO. While investors shouldn't expect the same blistering gains over the next 24 years, AI and cloud computing could act as significant catalysts for NVIDIA over the coming decade or more. The company pioneered the graphics processing units that render lifelike images in video games, but they also helped kickstart the AI revolution. The parallel processing capability of the chips or the ability to run a multitude of complex mathematical computations simultaneously proved perfect for the massive number of crunching needs of AI. NVIDIA quickly pivoted to capitalize on that need, developing software infused chips and systems to provide turnkey solutions for AI. NVIDIA GPUs are already the gold standard for cloud computing and data center operations, proving equally adept at speeding data through the ether and are the choice of all the largest cloud infrastructure providers, including Amazon Web Services, Microsoft Azure, of course, Google Cloud. NVIDIA's data center segment, which include processors used for AI, has been on fire so far this year. For its fiscal 2024 second quarter, data center revenue soared at 141% year over year to a record $10 billion. Management believes another consecutive record setting quarter is untapped thanks to AI. Okay, let's see. The EV makers' third quarter deliveries whiffed on expectations. The aggressive price cuts appear to have materially affected its top line, despite the challenge Tesla is doubling down on its long-term vision. Okay, one of the most scrutinized companies on Wall Street is electric vehicle maker Tesla. Its eccentric CEO Elon Musk is a media darling who seems either capture the fandom of many polarized the investment community at large. Tesla has done a tremendous job in bringing much needed innovation to the automobile industry. Hmm. However, after it recently fell short of delivery estimates, uh, investors just got a full blown picture of how the business looks. And it's not good. As Tesla's stock price continues to crater after third quarter earnings, some investors may be wondering if the party is over or if this is a unique buying opportunity. While quarter three left investors with more concerns and positive affirmations, I still think there is plenty to like. From new product launches to a strong capital structure, Tesla is well positioned to succeed in the long term. Anything that can go wrong will go wrong. In early October, Tesla released delivery and production figures for its vehicles during the third quarter. Management had hinted that quarter three production would be muted due to upgrading some of the company's factories because some brief shutdowns. However, while Tesla managed to post respectable growth on an annual basis, the sequential growth profile from the second quarter decelerated by noticeable margin, and the company missed Wall Street expectations. In other words, the ball was already set pretty low to the still missed the mark. The big question was how these misses were going to affect the broader financial picture. The EV space has become increasingly crowded, with new entrants such as Rivian, Polestar, and Lucid. In China, which is one of Tesla's biggest markets, the company faces fierce competition from the likes of NIO and BYD. As a result, Tesla has resorted to aggressive price cutting strategies, a move that has no doubt weighed on the company's margin and cash flow. The table below illustrates several important financial metrics for Tesla per its most recent earnings report. To put it bluntly, this financial profile is not good. Operating expense and capital expenditures are rising at a much faster pace than revenue, resulting in significant margin deterioration and less free cash flow. While positive free cash flow is a good sign, the primary reason Tesla's cash balance increased so much during the quarter is due to the company drawing on debt facilities. On the revenue side of the equation, investors should take into account the macroeconomic environment and how it can affect a business like Tesla. The Federal Reserve has been raising interest rates for over a year in an effort to curb inflation. As a result, mortgage rates are rising, as are loan rates for cars and even solar energy products. Since Tesla's primary end markets are cars and solar panels, the company is facing an uphill battle regarding consumer sentiment. Concerning expenses, Musk spoke at length during Tesla's quarter three earnings call as to what drove the rise in capital expenditures and operating costs. Increases were primarily attributed to the company's ongoing artificial intelligence pursuits, including self-driving capabilities. Management made it very clear that research and development costs and capital expenditure will continue to rise in the near term as a result of the company's AI roadmap. Given this outlook, investors might be wondering what good news Tesla had to report. One of the more interesting highlights from the earnings call was getting an update about the long-awaited Tesla Cybertruck. Management said the Cybertruck delivery should begin next month. While this new vehicle presents a meaningful opportunity to acquire market share in the pickup truck market, which is currently dominated by legacy automakers such as Ford, Musk tempered expectations when he stated it could take a year to 18 months before it is a significant positive cash flow contributor. In other words, investors should continue expecting cost rise as production ramps up. All-in cost rise while revenue growth stalls may appear convoluted, if not alarming. But remember, Musk and his team didn't build Tesla overnight. The company spent several years investing billions of dollars building factories all over the globe, working relentlessly to find ways to lower production costs and reach consistent profitability. While any profits from AI are years away, Contrarian may point out that Tesla is still investing in growth innovation during an otherwise cloudy economic period. In other words, Tesla can actually afford price reductions and still have cash left over to fund its roadmap. Meanwhile, the company is making massive solution forwards and disrupting a new market, namely pickup trucks. And should you buy deep in Tesla? Since reporting quarter three earnings on October 18th, Tesla stock is down over 16%. The delivery miss has a significant effect in Tesla's financial profile, and the prospects of rising caution near term likely didn't sit well with some investors. As of this ride, Tesla stock is up over 70% in 2023. That's after the recent sell-off. Moreover, since the stock started its crater, now it's traded almost 30% below its highs. Early this year, from a price-free cash flow standpoint, overall, I view Tesla's quarter three as a mixed bag. On one hand, it looks like the financial profile is getting worse. However, for analysis may suggest otherwise. Well, I believe the company will continue to face its share of challenges. It's important to keep in mind that every vehicle manufacturer is virtually in the same boat. While sets Tesla apart is its steadfast product vision, um, ranging from new vehicles to AI and strong liquidity profile. For these reasons, I think now is a fantastic time to buy deep. At current trading levels, investors have rare opportunity to lower their cost basis in this growth stock. Mm. Shopify is the anti-Amazon. Its platform allows e-merchants to set up sales sites independently without using Amazon or other large providers to support it. Shopify should benefit investors who wait because it stands out for its highly customizable platform that does not require coding skills. Also operates on an ecosystem that can support inventory management, email marketing, payments, and other functions necessary for an online business. Such capabilities probably help make it the number one e-commerce platform in the US according to Bold Wealth. Additionally, its revenue of $3.2 billion for the first half of the year rose 28% versus the same time frame in 2022. Had it not been for a $1.3 billion impairment charge from selling its logistics bit, it would have earned a positive net income. While the stock has risen by about 55% this year, it still sells for 7% less than its all-time high. Also, its 11 price sales ratio is low by historical standards. Um, these conditions not only indicate that good returns could come to those who wait, but it may also be an action time as shares in software service stock. Okay, this is my last article. Okay, retail sales remain robust despite the current challenge of inflation. E-commerce is expected to grow at a fast clip in the coming years. As one of the dominant e-commerce platforms, Shopify stands to benefit. If you're eyeing shares of Shopify, consider these factors. Despite inflation, high interest rates, and a budget housing market, the American consumer has remained surprisingly resilient. The Consumer Price Index, the standard metric for inflation, rose 3.7% in September. This was on par with the August increase and slightly lower than August when taking out food and energy prices. But retail spending is strong, and so is e-commerce, which is great news if you own shares of Shopify, the popular platform for online stores. Americans are still spending. According to data for the month of September, retail spending increased 0.07% from August and 3.8% from last year, outpacing inflation. Hmm. Although the U.S. Department of Commerce didn't break out e-commerce sales in September retail sales report, hmm, they increased 2.1% in 2023 second quarter, when overall retail sales remained essentially flat year over year. After a massive rise early in the pandemic, followed by a distant drop, e-commerce sales are still making their way back up. But it's going to keep getting better. According to Statista, e-commerce sales are projected to increase at a compound annual growth rate of 11.2% through 2027, hitting a market penetration of 66.6%, up from 57.2% this year. One of the world's largest e-commerce platforms. Shopify is growing faster than both Amazon and Walmart. Many other e-commerce retailers, GMV increased 17% year over year, second quarter, and revenue, which is its piece of the GMV pie, increased 31%. As e-commerce continues its upward peak, Shopify is poised to benefit. Okay, this is it. See you and have a good night. Okay, bye bye.